Danielle, thanks so much for coming back on. We really appreciate it.
It is great to be here. Happy Fed Day.
Happy Fed Day indeed. Will J. Powell see his shadow at 2 p.m. Eastern? I guess we can wait for your ultimate call here, but let's kind
No,
of get in.
I'm actually happy to give you. I'm actually happy to give you that right now,
Go right ahead.
and just say my answer is I don't know. If he
Okay.
does give us 50 basis points, the least he has ever had probability be was 79.8% before actually making a move. So 75% tends to be the threshold under which the Fed will not defy the market. And so they consider anything south of 75% to be in defiance of the market. We're 9 basis points shy of that at 66% right now.
Wow. So just to reiterate, to use my public school math here, you're saying anything shy of 0.75 is in defiance.
Correct. They want for the market to be just about completely sure that they're going to take that move.
Wow. So what do you then make of Senators Warren et al.? They started barking back in summer, asking for major cuts, lamenting the fact that it wasn't done fast enough. And they just came out, 2 days ago, asking for exactly that, 75. What do you make of their request?
So at the risk of sounding like Jay Powell would want to do something of a retaliatory nature to Elizabeth Warren because of the years of berating that he has sustained by her in person in congressional testimonies, he's really not reacting or non-reacting to her. She's a non-entity as far as he's concerned. And it's not because he's oblivious. He is, since Volker, the Fed chair who has been in the White House the least. But according to FOIA public records of his calendar, which is a matter of public record, Jay Powell has been up to the hill and on both sides of the aisle and had more meetings with Congress people than any of his predecessors. So he is very much in the thick of the thinking of the people of Congress. It is an extension of the Federal Reserve district system. 12 districts provide reconnaissance on what's happening in their area of the country every time the FOMC meets. You have to present a regional economic outlook, and this is an extension of that, to listen to all of the Congress people, as he has. Our three progressives who like to make headlines for themselves going to sway Jay Powell, who's the most apolitical Fed leader since Paul Volcker, who the great big man used to bring people, the press and staff into a room and explain to them why the Taylor rule was a bunch of BS. But he is the least political Fed chair since Paul Volcker and could give two damns what 3 senators want him to do.
Okay. I've heard you say before that he is the least political, and that's sort of heartening. I guess that's what you want in a Fed chair. How would you thus far kind of compare his tenure to, say, that of Greenspan? You mentioned Volcker. I just don't think there'll be another Volcker in our lifetime. Someone that gutsy, but and I know that's a controversial take, but.
Well, if you think about what Powell has done in the last 2 years to his quote unquote buddies in private equity, and what Fed policy has done to the value of some of their buildings, something tells me he's been thrown off a lot of holiday card lists.
That's hilarious. And do you think he'll survive the next administration? Do you think they'll keep him on?
Really, it's not their choice. There's a 1933 Supreme Court precedent that dictates that the members of the Federal Reserve Board can opt to keep Powell in his place until the Supreme Court has ruled on the constitutionality of removing a full head of a federal agency, which of course Jay Powell is. His email address ends in .gov. But this goes back to a 1933 Supreme Court case where where FDR tried to remove the head of a federal agency. And posthumously, the Supreme Court ruled that if it's not for cause, they cannot be removed. And cause, as defined in Jay Powell's job description, at least, would be not making monetary policy in the quote unquote interest, in quote unquote public interest, which is at the very front of the Fed's website. So if he's not being politically malleable, that is not cause. And just like the filibuster rule, that neither side wants to see that go by the wayside, the board, even though they're chock full of progressives who disagree with Powell, they would still opt to keep him in for fear of a precedent being set that any future sitting president could knock one of them out of their chair as Fed. So it would take some time. If on day one you fired Chair Powell, it's doubtful that by May of 2026, the Supreme Court will have ruled.
Really interesting. I guess technically he's not part of the cabinet, right? It's not like
no. He's not a political appointee.
Yeah, right.
That was why it was shocking. I mean, shocking to see Kamala Harris in her position as vice president have to swing vote Lisa Cook's passage onto the Federal Reserve Board because she was considered to be such a political appointee, and they're not supposed to be. You want 66, 67 at least. And remember, by the way, since we're talking politics, but not talking politics per se, but Kamala Harris was one of a small handful of senators in 2018 to vote with Elizabeth Warren against Jay Powell's confirmation. Very few did it. Kamala Harris was one of them.
Yeah, that'll be fascinating to see how that works itself out. Should she ascend in November? Fascinating stuff. If you're just joining us, you're listening to Truflation Spaces. It is Fed Decision Day, everybody. I think we're all expecting a cut of some kind. I can't think of a better person, a better analyst out there to share this day with and to get insights from than Danielle DiMartino Booth. She's all over FinTwit. She's always in the top 50 in terms of citation. She's the go-to gal all over financial news. Again, we're extremely lucky to have her. Without burdening her further for the moment, I give her a chance to kind of catch her breath here. We do have our head of product, Oliver Roost, who we've missed for the last couple spaces. He heads up pretty much all of our research, and that inflation report that you see monthly, highly anticipated, itself is kind of go-to for the industry. He's back joining us today. Hey, Oliver, how are you, brother?
Good to be here, and good to have Danielle on the call as well. It should be an exciting call that we got ahead.
Yeah, good to hear your voice, Oliver.
You too, Danielle.
Well, very cool. Let's get your take, Oliver. Kind of the background setting for all of this. I know it's kind of unfair to throw it at you unannounced here, but I figure if anybody can handle it, it's you. What are your thoughts going into today? 2 p.m. Eastern is when Powell will take to the dais, to the podium, and kind of let us know what the decision is. What's your feeling? Kind of just your general impression.
Yeah. So look, I think when we produced the inflation report for August, I think there were some surprising numbers coming out. It's about the strength of the economy. I know, Danielle, you wrote an article released in your newsletter today around the dependency on one figure. But yeah, the retail sales numbers are certainly fueling a stronger GDP number and stronger GDP growth. And that everyone was expecting that GDP growth in quarter 2 to come down on the first revision, but in fact it went up, and it went up because of the strong retail sales. You can argue that some of the strong retail sales is a rebound of the auto category and the car sales, but in essence, the retail sales in July and August have continued to be relatively better than expected. I think also in August we saw the industrial production numbers better than expected. They've bounced back up to where we were in July. Certainly not great, but it's certainly going better than expected. And I think, you combine those two factors and you say, well, if the Fed's not really seeing a strong indication of a recession ahead from a GDP perspective, and in fact it's gone the other way, you would be more inclined to say, okay, there's a 25 basis points reduction is going to happen. And I think you combine that with inflation coming down to 2.8% as the BLS reports it. We certainly think it's lower than that, and we also do believe that as interest rates come down, there'll be this pent up demand that will return inflation upwards again. So if interest rates come down too far, and given the fact that we have no meeting in October, the next meeting I think is on the 1st or 2nd of November, if memory serves me correct. I think if you take the prudent approach, it would be a 25 basis point cut. So therefore, what's the driver to go to 50 basis points? I think is the other mandate of the Fed, which is the labor market. And that certainly has seen some softening. The unemployment rate, as the BLS reports it, is certainly gone the other way. In last month of August, it came back down to 4.2. I think you have other factors in the unemployment rate that are anomaly that are not being reported, be it the birth death rate model, be it the number of immigrants that are coming into the U.S., either documented, undocumented, that are not being registered by the BLS. And that, I guess, is also the key driver behind the reduction in the wages, because they tend to take more the lower paid servicing jobs. But I also think, on the flip side, you're also looking at other factors like, the rate of startups going bankrupt has definitely accelerated. And, the small, medium enterprises, the small businesses have been in the past the key driver of the US economy. And they're starting to see an acceleration rate of that. And then, couple that with recent layoff announcements, I think the unemployment market is a bit hazy and a bit gray. We certainly think that the unemployment rate in the US is underreported, but I don't think it has too much of a detrimental impact on demand, because it tends to be more on the lower end of the spectrum, and the consumer expenditure that's driving the economic growth is more on the higher end. And so, you could argue from a labor perspective, there's been some softening, so they maybe go down to 50 basis points. But I think that would be an aggressive move. I am more of the opinion that, and this is only an opinion, right? But it's the opinion that I think they'll go for 25 basis points, look where they end up, and see where they go in November. And there's going to be a lot more data points coming out to give them a bit more guidance what they do in November. The only flip side of that, of course, is as you and Danielle were discussing earlier, and I'd be keen to get Danielle's viewpoint on that, is the political ramifications. I know the Fed is apolitical, is meant to be apolitical, but with the elections coming up, will they play a part in trying to reduce the interest rates further to, show signs of a strong economy and help some voters switch their minds, change their minds on who they go with?
Oliver, I've only got 4 talking points I can reply to. 5 hits my mental quota, and you have to say everything all over again.
Okay, that's it.
Okay. Several press conferences ago, he was specifically asked, is September a live meeting? He got angry at the podium, which is hard for a Chevy Chase golfer to do. Yeah. But he did. He got angry at the podium and he said, every single meeting is live. And he means it. If it's 25 or 50 today, it has nothing to do with the woman who voted down his confirmation in 2018 or the orange man who chased after him for 4 years trying to berate him after he nominated him. So it has nothing to do with politics today, November the 7th, or for the December meeting either. On consumption, let's go there. We've lost on a net basis, we've lost north of 1 million jobs in the last 12 months. That's been more than offset by part-time job creation. But US GDP is 70% consumption. If you lose more than 1 million full-time paying jobs, and those are only offset by part-time paying jobs, in the aggregate, you see consumption destroyed. We saw something highly unusual in the last Beige Book. And remember, the Beige Book is something that is carefully surveyed and crafted and written. And it is an internal Federal Reserve document. They pay extraordinarily close attention to it. To have 12 of 12 districts, 12 of 12 districts note faltering consumption is quite extraordinary, because there's only 3 recessions. There are 3 recessions that you can cite: 1970, 1982, and 2001, in which consumption was positive inside recession. Inside recession, consumption was still positive. Business investment dictates 93% of your recession probability. On the retail sales front, since you mentioned it, if you look at an aggregate of autos, home goods, furniture and home furnishings, electrics and appliances, and building materials, if you combine that into an aggregate composite, it is completely flat year over year. It looks like a comatose person or a dead person on the EKG monitor, DOA. That's what that looks like. So anything that the Fed could have impaired consumption-wise, that's interest rate sensitive to any extent, any big ticket area of retail sales, has seen weakness. In fact, the driver of retail sales yesterday was what? It was online retail sales. Well, that's great, Danielle. It reflects Amazon Prime Day, except Amazon Prime Day was July 16th to July 19th. That was in July. We actually saw weakness in online sales. Why then, Danielle, could we possibly have seen online retail sales rebound as strongly as they did in August? Well, that's because your grocery store brick and mortar retail sales declined while online went up. People are desperate to find the absolute lowest prices. Where do you do that? Online, for essential spending. On a final note on industrial production, and this is where I would say, buckle up, Buttercup. That particular measure, if you're looking at business investment, business equipment, that series, it is down year over year. It's down. It had a slight pop yesterday, 2.2% in August on a month over month basis from July's two-year hold. But it literally has been in a flat line year over year. It's been negative. It's contracted in 12 of the last 13 months, year over year, ended August 2024. Are we going to have blips? We are. What was one of the main drivers of industrial production? A massive jump back in autos and auto supplies, which of course you see after the July shutdowns. You see a huge pop in August. It's a 1-month aberration and did not take away from the year over year string of contractions in industrial production. So I think that was the fourth. And thank you.
It's you've. I can't remember the last time we talked, but I think it was back in maybe spring of this year, and you were boldly kind of saying, "Oh no, we're already in recession." And it's funny because back then you sounded a little cranky, like, "Oh boy, here she goes." And then it's interesting. Everybody's coming your way, which I know is flattering for me to say because you're our guest. But it is true, right? Because Peter Thiel was on All In, I believe, and they were asking him his general thoughts on the economy, and he was like, "Look, we've been in recession. It's just the government's printing so much money and pushing out and sort of papering over what is the inevitable that they've pretty much run out of tricks." I'm sensing that you might agree with that assessment, but I've not really heard you take on monetary policy. You're more in the weeds analytically, right?
I am. I do live in the weeds analytically, and the irony is, if I'm in New York, if I smell marijuana, I have to stop and try and not vomit. So, but I am deep in the weeds, like the regular kind of weeds. But But to the point of those saying, you really are, looking at yesterday's data. When we saw private non-farm payrolls, right? Give me a guess, and I'm just going to throw you on the spot. Percentage of government and healthcare jobs created out of total job creation last 12 months. Just take a stab at it.
It's
That's
about
Oliver.
70% of it. It's about 70-80% of it. It's the bulk of it.
It's actually only 50%, 50, last 12 months.
That's
But
still crazy.
if you isolate private non-farm payrolls as they were originally reported and lauded on the White House lawn, and life is good and the consumer is strong, and Brian Moynihan is looking for position in the government, he reiterates the consumer is strong from his position at Bank of America. But if you look at private non-farm payrolls, they were originally reported as 2.4 million. And once you get those monthly revisions baked in, when your survey response rate creeps up from south of 40% to whatever they get it maxed out at, something 90%. Once you back out those monthly revisions that we read about, the number comes down to 2.2 million. Now, after the benchmark revision, which shows things like Amazon, if you're not, get your happy ass back in the office 5 days a week, or performance improvement plans, all kinds of ways to cut your head count with attrition. Once you get to the number that companies are legally obligated to report to the census on a quarterly basis, you actually, after that preliminary benchmark in the 12 months ended March of 2024, you find out that it wasn't 2.4 million jobs created in the private sector in the 12 months from April of 2023 to March of 2024, but rather 1.4 million. So more than a million jobs eviscerated after we see the benchmark revision. That will filter through, with deference to those celebrating the Atlanta Fed GDP, blah, blah, blah. That will filter through thus to GDP after you back the income out and all other sorts of fun things. People don't like to talk about it. And you should see me at cocktails, right? People see me and run away. But, we have to remember, Q1 of 2001 was originally reported as 2% GDP growth, and the dust settled at negative 1.3%. That's where that GDP number settled. Q1 of 2008 was originally reported as 0.6%, went up to 1% with the third revision, and it was eventually revised down to negative 1.7%, reflecting that we had been in recession. My message to you is, you can rely on what is initially reported if you like to live in Fairyville or you're a rates trader. But your data, Truflation data, is telling you exactly where we're headed, and that whether it's 25 or 50 today, Jay Powell's so picking behind the curve, he's never going to catch up.
Wow. That is sobering. Go ahead.
But based on that, Danielle, what is your viewpoint of where he would go if not whether it's 25 or 50 today? Where does he go later on in the year? Based on what you're seeing and how you're looking at the outlook, what do you think happens later on in the year in the November and the December meetings?
So even though people like to fantasize about the Fed being halting and pausing, and look back at history, once easing campaigns begin, once you cross that lovely Claudia Psalm line in the sand, your unemployment rate starts to move up quickly. Why was it stickier this time? Well, everybody's pouring into the gig economy. I can make $295 in the state of Tennessee for a maximum of 12 weeks, up to 26 weeks in other states, or I can drive Uber. So I'm not going to flow into the pool of unemployed. I'm going to pick up a gig job. And we've seen this. We've seen millions and millions of these jobs created. But once you cross that Psalm rule line, and once the gig economy is pretty much saturated, right? Part-time jobs right now are equal to the peak of the 2007-2009 recession. The number of part-time workers in the United States, equal. So I would dare say that we're approaching the line of saturation of the next million who try and become Uber drivers. So with that in mind, if we're in recession, which I believe we are in recession, Jay Powell is thinking to himself, okay, look, 350 basis points was sufficient to pull us out. And at that time, it got the Fed to the zero bound. He does not like the zero bound. It's a failed experiment. So if you say 350 basis points, he gets to 2%, he stops. every single meeting, we should see a cut starting today.
Wow. Wow. If you're just joining us, you're listening to Truflation Spaces. It's Fed Decision Day. We've got Danielle DiMartino Booth breaking everything down for you. I'd be remiss if I didn't also tell you that this is all sponsored by Truflation.com. And we also have on the stage here our our head of business dev. Her name is Betty. And she's got a pretty cool offer that I wanted to make sure we mention for anybody out there with a college student who can prove it. Betty, can you just quickly kind of give us a little advert here as to what we're doing in terms of back to school?
Yes, absolutely. What we're doing from now until the end of October, for any student, you don't have to be a finance major. I mean, myself, I was an English literature major, and here I am in finance. So it doesn't matter what your area of study is. If you have an interest in our pro package, you can go to our website. Under pricing, you will see this is an $888 a month package that we are giving to students for free for 1 year. And, again, so you can go to our website. You can reach out to me, Betty, at Truflation.com. or at sales@truflation.com, and we can get you set up and get you going. Again, for students. Until the end of October, this offer is live.
And wow. Actually, students care about what I'm going to say next. And that is that students are studying the idea, the concept of correlation, right? And Truflation's correlation to headline CPI is 0.97%. So it's 3 percentage points shy of what we call perfection. And post-pandemic, it's actually 0.98%, the correlation. So any of you students listening out there, well worth your investment to follow this, because you are literally looking out over the horizon at the future of headline CPI, which tells you that had 1.01% last Friday dipped below the 100 basis point year over year line, we would be in extraordinary circumstances, because we would be contemplating how the Fed is going to handle deflation.
Wow. Yeah, it is nuts to think about. And before we turn back to Danielle, we want your questions. We want your comments. I've already got 3 people up, and we're going to get to your question in just a second. We also have a pretty special guest as well that we just brought on over the last couple of months. His name is Rodrigo Flores, and he's based in Latin America, in Peru, and really interesting guy, solid guy. But he's writing a regular column for us that's featured in the newsletter, especially on LinkedIn. So if you're on LinkedIn, follow Truflation, and you'll get his columns regularly. It's called the Afuera Report, or Afuera Report, and it's really interesting look at Argentina, because we're tracking it. So let me ask you, Rodrigo. Questions for Danielle in terms of the global impact. How closely, Rodrigo, does Latin America follow the machinations of the Fed, the U.S. central bank? Is it something that Latin America pays a lot of attention to?
Hello, can you hear me, guys?
Perfect.
Hello, Rourke. Hello, everyone. Well, it's nice to be here. And yeah, I mean, actually, the information that right now you guys are sharing, like Oliver and Danielle, it's amazing. I mean, it's really an overload of information. Economy is really complex, and I think that everybody's trying to keep track on it, but sometimes we fall short, definitely. And regarding Argentina, yeah, there's right now, like all the, for example, the Latin American economy news are really expectant on what they are going to say today. For example, right now in the country I live in, which is Peru, our inflation rate, it's on par with the U.S. rate. So somehow we follow a similar system. And Argentina as well has done tremendous advancement recently. Like, for example, in its stock market, it has increased. Like year to date, it's the biggest global stock and economy market right now that has risen up to 44% year to date. So it's even bigger than the S&P 500 right now, and it's of course because it's coming from a really high inflationary period that has gone through, and still like Argentina is still like waiting for all these like economic decisions to trickle down to its population, right? So hopefully we're going to see inflation coming down. But yeah, like for example, right now in Latin America, some analysis I've seen, it's and it's something that we also see on X, on Twitter, is that people are thinking, right, what is going to happen to the market if the Fed decides to cut like 50 basis points, because we have seen that like this happen on 2001 and 2007 when these cut rates campaigns have started with a 50 basis points cut. It usually hasn't gone so well in the future. But yeah, I don't know what Danielle thinks about that. I know that she holds a lot of different variables that definitely are interconnected in that. But yeah, I've seen some people mention here in Latin America about that. Like 50 basis points would be bad because we've experienced that during the 2001 crisis and 2007 crisis. And usually 25 basis points cut throughout the whole rate of campaign has actually been better. We have had that in 1995, in 1998, and in 2019, right? Without counting COVID that came later. But yeah, I would like to ask that.
So just that was very long, and that's okay. Hablo español y yo entiendo cómo estamos hablando, eh? Todo es como una historia. But can you condense that just a T9C bit, please?
Yeah. Oh, I didn't know you spoke Spanish. That's great. But yeah, so basically what I've read is that people were talking about how 50 basis points on the first cut rate was usually associated with recession periods. Okay. Like it happened, that happened in 2001, 2007. So a sector of these economies were saying that we better have like a 25 basis points first cut rate that keeps throughout the whole campaign, of cutting rates, because that would be better on the economy.
Well, so again, this really is all about messaging today, and it's clear because of a certain person on Twitter named Nick Timoros that they went from highly advocating 50 basis points on Friday, given the tone of what he was writing, to being much more nuanced. And we're going to discuss every single little tidbit of data before we decide. So very nuanced by yesterday afternoon. And if they can avoid 50 basis points based on what they believe the data to be saying, and they know that even though interest rate sensitive retail sales are in the toilet, they know that. They're economists. They dig in the weeds too, that the headline retail sales number should have given confidence, and that the housing starts data should have given confidence. And so going into the meeting, they know that superficial high-level prints for these data points suggest that the U.S. economy is doing just fine. Atlanta Fed GDP, it was revised upwards yesterday. Is it anything more than a reflection of what the anticipation is for non-farm payrolls? According to my good buddy Mike Green, no, different story, different day. But it doesn't matter. The headlines suggest that the Fed can go 25 and thereby avoid messaging that we're in recession. But the fact is, whether it's 25 or 50 is irrelevant because they're so far behind the curve. So they could theoretically go 25, and they have always wanted to go in 25 basis points increments and go as steady as you possibly. They want to replicate the Greenspan era. That's what they want. They want to convey that this is a soft landing, and therefore they do not need unusually large rate cuts. But I dare say if they go only 25 today, because they're so far behind the curve, because you have companies like Verizon saying in a footnote, we let go of 4,800 people, and other major layoff announcements in just the last few days, because of what we know is being destroyed with full-time income, they can start with 25. They're going to be forced into 50 basis points pretty soon here.
Yeah, they've just run out of runway. Excellent. It's a good time to bring in some questions. I've got, let's see, one, two, three people up. Let's start with Andrew Sinclair, CFA. Andrew, you're up. Your question for or comment for Danielle. Go right ahead, Andrew. I can't hear him. Can anybody hear Andrew?
I cannot.
Nope, I can't either.
Hey,
Okay.
is this better?
Oh, there you are. Yeah, go right ahead, Andrew.
Sorry about that.
All good.
Listen, I was just clapping and endorsing the podcast. I didn't mean to put my hand up for a question, but since you have me here and you have a great speaker in Danielle and a gentleman from the emerging markets point of view, we know the Fed's going to cut today. What are your guys' thoughts on what the Bank of Japan's going to do later this week and its impact on things globally, particularly, I think, on deflation?
Excellent question.
If this question is directly for me, I certainly don't think the Bank of Japan is finished in its campaign, but I think that the United States by far wields the greatest amount of power, if you will, in its campaign. That does not say in any way, shape, or form that it doesn't matter, but we have to remember that Japanese sovereign debt is largely owned by the individuals in the country. So the implication or indication of a global fallout is less than it would be if this was the Fed in the same shoes as Japanese policymakers.
Interesting. And it's the carry trade stuff all over again. I've been hearing about too. We've also got a comment or question from. Yeah, I'm gonna say no to that. Let's go to.
And I thank you for that.
Yeah. So I just read. Woo, almost did it. Oh man. It's just been a hell of a morning, guys. I'll just put it that way. Anyway, we're gonna go to Tim. Tim DeKill. Hey, buddy. You're up. Question for Danielle DiMartino Booth or comment.
Hello, can you hear me?
Yeah, go right ahead.
Hey, so with the Fed possibly cutting like half a basis point, right? Do you think that that's gonna make the average American like have more affordability in their lives? Do you think it's gonna improve the cost of homes, or do you think we're gonna just go through another inflationary session all over again?
Great question.
It was a great question, but you asked the same question two different ways. And the answer is 25 basis points or 50 basis points. Most of that has already been priced into the mortgage market. Of course, we've gone from north of 7 to wherever we are, close to 6 on your 30-year fixed. And you have seen the level of purchase applications pick up off the lowest since the early 90s. But on a level basis, we really haven't seen too much movement. Cancellation rates to buy homes are ticking up right now. People falling through and not being able to get the financing from the banks is going up. The ability to tap into your home equity is going down. Lending standards they're tightening as banks are trying to get their arms around the level of credit card and auto loan losses that they're going to take, that they need to thereby batten up their balance sheet in other areas in order to protect the entire balance sheet, right? So it will potentially help some fence sitters at the margin, but in the aggregate right now, what trumps any level of borrowing costs, again, which have largely been priced into the mortgage market for your biggest ticket item, you're not going to see car loan rates come down. You're not going to see credit card rates come down. You're not going to see any kind of watershed moment. You'll see people with pristine credit be able to come out and refinance their mortgages. That will be good for consumption for that demographic, for that cohort of borrowers. So you will have some money freed up, even if it's just 25 basis points. If it's 50 basis points, you might have a few more freed up. But in terms of that filtering through just yet to home price increases, given the rapidity with which we're seeing inventory pile up. And people keep saying, oh, it's only in a few states. And I'm like, yeah, it's only in a few of the biggest states on the planet that happen to be countries in and of themselves. So it's going to take some time. I dare say we'd have to get down to the zero bound really to try and move the needle on home prices.
Got it. Got it. Another question for Danielle is Nate Volker's thesis. Question or comment for Danielle? Go right ahead.
Thank you so much. Miss DiMartino Booth, I've been following your work and loved your book, been following you for years. I don't want to get political because I know that you have a firm rule on that. But what I do want to say, it's a little different question from the rate cut discussion, because whatever happens, like you said, I think there's only one way they can go. I wanted to actually get your thoughts, if you wouldn't mind, about Fed personnel in an ideal world going forward, given your experience at the Dallas Fed. I'm going to put your interview in the bubble below. If you see the bottom right-hand corner, I thought your interview with Professor Richard Werner was one of the best I've ever heard. I think he's fantastic. I'd love to see him be on the Fed board. I'd love to see you on the Fed board. But I wanted to know real quick, what you think of people, not just like him, but what types of people you would like to see on the Fed board going forward. And I'm going to put that interview below for everyone else's benefit.
So, I would like to see fewer overt progressives on the Federal Reserve Board. They're the only individuals, of course, who are confirmed by Congress. The individuals who work in the 12 Federal Reserve districts, their email addresses do not end in .gov. They end in .org. But I would like to see a future president appoint more practitioners to the Federal Reserve Board, more sound money individuals to the Federal Reserve, more individuals who understand the banking and financial system and the transmission mechanism of monetary policy and how it flows through and into the banking and financial systems, as well as the real economy. And I think in order to do that, you have to reduce the ratio of academics that you've got sitting on that board and increase the number of individuals who understand what it is like to be on the receiving end of monetary policy and how that plays out in running money, running a business, running a bank, running a banking system. So we definitely need more people who are on the ground and have a better understanding of how very conflicted the Fed's dual mandate system is. So that would be my short answer.
Excellent, as always. If you're just tuning in, it's Fed Decision Day with Truflation Spaces. We've got the great Danielle DiMartino Booth and a lot of questions waiting for her. Next up is Terrence. Terrence, your question, comment for Danielle.
Yes. Hey, Danielle, big fan. I had a question, which is, do you think the Fed purposely maneuvered itself to a place, through the Fed Whisperer at the Wall Street Journal and other things they did to a place where the market is kind of split? They purposely and intentionally did that between 25 and 50. And so whatever they decide to do, they can make a last minute decision. It should not roil markets, right? Does that feel right?
No, it feels very wrong. And the Fed did do exactly what you described. But again, when Nick's first column, faux pas article, my second degree is in journalism. But when Nick's first article hit on Friday, it was much more hard hitting in favor, advocating for 50 basis points. The final word that he had on it yesterday was much more tempered and brought probabilities south of the 75% threshold, over which you typically have historically needed to see any probability before making that move, which we're not at right now, right? We're at 66% with just a few hours to go. I do think that they deployed Nick Timiraos very purposely and decisively and wanted to see the chatter that was ignited or not ignited, right? Bank of America came out yesterday afternoon pounding the table in defiance of my buddy George Goncalves at MUFG. and Michael Ferroli at JP Morgan Chase. There are 7 of the 112 individuals queried by Bloomberg who believe it's going to be 50 basis points. That is an overwhelming minority of those who believe that 50 basis points is going to be the go. And at this point, if the Fed is going to shock the market, it's going to do so by breaking the back of history and historical precedents and potentially lowering rates by 50 basis points. And then you end up with high degrees of volatility because the Fed's broken its own historical precedent of not going if the probability was not at 75% or higher. So follow that into the next few hours. But the difference between June of 2022, when Nick Timrose was deployed on a Monday before a Wednesday meeting, was that the probability was rose to 89.9% from something that was like single digits the Friday before, but it rose all the way to 89.9%, specifically because large investment banks jumped on the bandwagon that said, we actually agree that the Fed's going to go 75 basis points for this hike. And that sent probabilities well north of 75%. And indeed, it was a 75 basis point hike that was delivered at 66%. Right now, we are not there.
This is your chance to pick the brain directly of DDB, Danielle DiMartino Booth. She will be all over your media podcasts and spaces today. She's perched in New York, the financial capital of the United States. And I have a feeling she's probably going to be on Payne's show today, a bunch of other places. So this is your chance to get at her early and first. If you want to ask a question, make a comment, I'll bring you right up. Unless you're celebrating a dictator of some kind, and then I'm not going to do that. Let's see.
I don't do dictator. That's like it's a QI research hard stop.
You have to have a line somewhere, right? Oh my goodness.
But actually, so I'm going to interrupt for a second because of the flack that I get every single day when I post Truflation. Let's play distinguish for 1 second, okay? I can do basic math kind of with a really big calculator. So I can kind of get past basic math. I understand that prices are up north of 20% since 2019. I understand that. I understand that that still hurts. I understand that there are pockets of inflation that still have rising prices that are well north of anything remotely close to 2%, even though for the first time in years, we did see homeowners insurance rates decline yesterday. That was very welcome for all these homeowners out there. I understand that we have this inflation hangover and that it remains a huge source of pain and discomfort. But I'm telling you right now that if Truflation continues to decline, that means that we're seeing the continued decimation of pricing power in corporate America, which you have to understand and appreciate in isolation. Because when pricing power is decimated, Joe Q, Jane Q, CEO, CFO have no choice when profit margins are being killed, especially if they have shareholders, they have no choice but to fire people because that is company's largest cost center. And firing people is a lot more deflationary than people who have a paycheck and have to choose to buy ground beef instead of filet mignon. That's called a substitution effect. But my point is, I'm not insensitive or ignorant or blind to the inflation that has piled up like a pile of rubble since 2019. That does not take away from the negative implications of falling inflation, disinflation. As you know, we saw goods Truflation peak at 15%. For the love of God, it's negative year over year now. Huge delta in between the two. And it goes to show you that if it's something that I want to buy and my paycheck is shrinking, 1 million full-time jobs lost last 12 months, and my paycheck is shrinking, then I have less money to spend, and I am going to impair pricing power for vendors of goods and services. You can apparently get, if you want, a hotel room for the F1 in Las Vegas for a song. If you do, please invite me. I'm headed to Singapore to see the F1 there tonight. But yes, I will definitely join you. Direct message me individually, and I'm coming to Vegas to watch that one too. I'm a car guy. What can I tell you?
Two things can be true, right? So since September 2021, we have an aggregate or compounded inflation in the United States that's above 25%, and yet the rate of increase is slowing. And I think what Truflation does is it allows this discussion that's never really been had before, this daily, timely discussion, and we're all trying to kind of divine what these numbers mean. I mean, we put the numbers up, we have data, but it's up to everybody to sort of interpret them. It becomes a bit of a Rorschach test, and admittedly, some are better, like yourself, than others at really kind of seeing where the trends are. But as far as we're concerned, we've watched it go way up, come way down in the time that we've been live as a company. And we followed it both ways. And coincidentally, or maybe not coincidentally, as you say, correlatively, they've come our way both times. So every inducement for Truflation, and I'm talking every inducement, is for us to overstate the government numbers. So to go above them, because that's what people like. They like that doom and gloom, and they like that number. And so obviously, if we were goosing them, we if the, just for example, if the government's at 2.5, everybody would love nothing better if we're at 6 or 7 or 8. In fact, we're going the other way, which in some ways is data suicide, because people go, well, you're obviously a shill for the regime, and so on and so forth. So what I think...
Okay, there's actually a word for what you just described. There is a word for it. With deference to the people who have told me over the last few days, since Amazon said back to the office 5 days a week, who've said, over my dead body. Well, okay, fine. You can work from home 7 days a week if that's your choice. Go for it. But what you just described is integrity and data in your integrity, which is why I continue to be a devout follower and advocate for Truflation.
Amen. Amen. The internal discussions, it's one of the many reasons why I like working for Truflation. It's everything revolves around that word, even if we don't say it. It goes into everything we do. So excellent point. Heading into the last 5 minutes here, let's kind of I guess let everybody know. Obviously, you're on Twitter, and you're a great follow. She posts constantly. You will stay up to date on really everything that's happening macro. But where can people, Danielle, follow your work and keep up with you?
So obviously at DiMartino Booth on Twitter, but not if you're one of the people who wants Truflation to fudge their numbers. Go find somebody else. I won't name any names. But I'd love to see you come to Substack, DiMartinoBooth.substack.com. Tomorrow, for the first time since March of 2023, we are going to be publishing a full length of my flagship weekly quill that walks through how demographics going into this recession can possibly affect the structure of passive investing as the Fed reduces interest income. Again, that is going to be FREE as of tomorrow. So please come to DiMartinoBooth.substack.com and read that. Again, since March 2023, I have not let anything out of the vault for free. I keep that for our institutional investors who pay me to keep it out of the public purview. But it's so important of a piece because we need to understand flows going into this particular recession. We need to understand what's happening because baby boomers don't have the optionality to rejoin the workforce at the ripe old age of 70 that they did when they were younger in 2007, 2008, 2009, when they did rejoin the workforce in droves. We had 379,000, really old, crusty people over the age of 55 in the month of August rejoined the workforce. Why? Because latent inflation, that 25 plus number doesn't work when your kids have kids of their own and they lose their full-time job. You turn and you say, Mom, Dad, you need to go back to work so that I can keep food on the table for the family. 379,000 additions to 55 plus workers in the month of August.
Wow. Well, she did it again for the full hour. She put on a clinic, took on all comers. That is the great Danielle DiMartino Booth. Definitely give her a follow right now on X here, and definitely get out to the Substack. I didn't ask about the personal finance stuff simply for the reasons she cited. If you want that, you have to get out and follow her and get her newsletter. I know Oliver reads it religiously, and we pass it around internally in Truflation as well. So, Danielle, thanks so much for coming on again. It really was a pleasure, and break a leg today.
Thank you so very much. It was great to come on this Fed Day. I appreciate your time, and I appreciate all the questions.
All right, everyone, we're back again on October 9th. We've got Adam Taggart and the great Amy Nixon. They're both great. But Amy Nixon, Amy will be discussing housing, and Adam will give us the macro picture as we anticipate the next BLS CPI print. That is again on October 9th. We should have some promos out there where you can set your reminder. We might have one kind of floating around already. But in any case, join us again on October 9th. Do again follow Danielle DiMartino Booth everywhere. If you Google her, you'll find all of her socials, her website, her newsletter, and of course her Substack. Thanks so much for tuning in. Great questions, everyone. And we'll see you on October 9th. Bye for now.
And Danielle, thanks a lot for joining us. And if you're in Singapore, let us know, because Stefan and I are here as well. So we can
I'm
see you
headed there
there
tonight. I'm letting you now know.
We'll see you when you get here.
Fabulous.
Thanks a lot again, Danielle.
Thank you.